This is a quick video just to review some of the basics of the balance sheet. We'll get much more into the various specifics as we progress through the course. We'll use the example of Under Armour's balance sheet from the text. This is a pretty stripped down balance sheet, but it helps to illustrate some of the basic concepts. The balance sheet is organized in terms of the basic accounting equation, assets equal liabilities plus owner's equity. As shown here, that equation can also be translated into the form of investing equals non-owner financing plus owner financing. The assets section of the balance sheet represents the investments in the business, and the liabilities and owner's equity section of the balance sheets indicates those who have a claim on those assets. That relationship is shown in the author's annotations along the side of this figure. Where is also shown in the annotations next to the totals, the assets section shows the total resources of the company, and the liabilities and owner's equity section shows the sources of the financing to acquire those resources. The amount that came from the owners is owner's equity, and the amount that was borrowed from various creditors and lenders is represented by the liabilities. The final point that I want to draw your attention to here is what is commonly referred to as the classification of the balance sheet. Balance sheets typically separate the amounts that are current from those that are non-current. Here, Under Armour is using the synonymous terms short-term and long-term. Current refers to those assets that will be converted into cash in the next year or less, and those liabilities that will need to be repaid in the next year. And non-current then refers to those assets and liabilities that will last for more than a year or be repaid more than a year in the future. There's obviously a lot more that can be said about a balance sheet, but we'll save those points for later in the course.